Hey everyone and welcome. There has been a lot of volatility in the markets in the last few days, and I know a lot of retail investors are wondering exactly what to do. Buy, sell, hold. The good news is there is a simple, easy answer. The bad news is that it is very hard to stick to it and be disciplined. So, without further ado, let's get started and let's get the bad news out of the way first. What are they? Well, I'm sorry to say it, but you are a human. The psychology and emotions of these type of situations are the hardest thing to handle. Fear, panic, anxiety, the fight or flight instinct makes it incredibly hard to assess the situation objectively, and it makes you a lot more likely to make impulsive decisions, especially if you have big positions or you have more money invested than you can tolerate. In case you are not aware, impulsive decisions usually lead to losing money in investing. Warren Buffett likes to say that rule number 1 is never lose money, and rule number 2 is never forget rule number 1. You may be thinking, okay, that's obvious, but what's the best way to avoid panic, fear, and impulsivity? Easy. Have a plan, have a strategy, have a strict approach to investing, and stick to it. I told you, it is very hard, and it relies on your discipline and the ability to remain calm. But really, if you have a detailed plan, you know how much risk you can handle, you know how much you can afford to lose, then it becomes really easy. If you don't have that, then make sure you get one now. Write it down so you can look at it when emotions start coming up. If that doesn't work for you and you keep getting emotional and making impulsive investing decisions, well, maybe you should consider passive investing in broad index funds. In all honesty, that may actually be the best way to approach the markets when it comes to investing as a normal, everyday person. Executing complex day trades, finding the best undervalued companies, analyzing technical indicators, looking at balance sheets, etc. That can be exciting, and it can make a lot of money. For some people. For most though, it is simply too much work, too much stress, and too much involvement. There is a reason why most financial advisors recommend you stick to broad index funds. They work. You may not be getting astronomical returns, but you are somewhat protected from downturns. If you are interested, I highly recommend checking out the Bogleheads subreddit. They have a lot of good information on the topic. Okay, so that was the bad news and how to handle them. Now, on to the good news. What to do? Buy, sell, or hold? Well, here's what my plan is. Are you ready? Do nothing. The worst thing to do right now is panic sell or impulsively jump into stocks. I definitely don't want to do that. Instead, I plan on sitting on the sidelines and watching. You may be thinking there are a lot of good offers on the table right now, and there are so many discounted banks and financial companies with amazing dividends, amazing prices. Well, here are some news for you. There is a good reason. Those banks with the high dividends? Yeah, the chance they're gonna get cut is pretty high if things go south. The main issue with Silicon Valley Bank and the rest was that they could not raise money fast enough to handle a bank run. Even though their balance sheets looked okay, they actually held a lot of discounted assets like the older treasury bonds with a lower coupon, which got devalued once the Federal Reserve raised rates. The same thing applies to a lot of other banks, which carry a lot of unrealized losses on their balance sheets. So unless you are certain that the banks or financial stocks you are buying will not be affected by this, they are really not worth it. The financial sector in the US is super fragile, guys, and there is a good chance that this is just the start. We don't know what will happen, and we don't know how things will evolve. Yes, the Fed is stepping in and bailing out the depositors, while saying that they are not doing a bailout, which is a classic Federal Reserve move. However, nothing is being done to assess or improve the bank capital requirements. There are no new regulations. There is no breaking up of banks. There is nothing done to improve the health of the financial system. All they are doing is making sure that the depositors get their money, so that they prevent a panic in the markets in the short term. But nothing is stopping this from happening again. When you consider that we have had a rapid increase in interest rates, stubborn inflation like we just saw, a very high likelihood of recession, several banks in the US failing, does that make you bullish on the stock market? It doesn't make me, I can tell you that. I personally think that the current outlook for the stock market is very bleak, and the best thing to do right now is be cautious, keep a bigger than average pile of cash, and wait to see where this goes. There is a saying in trading, don't catch a falling knife. They can make for a very profitable short-term trade if these stocks bounce up, and in fact, most of them have. But they are also incredibly risky, and there is a high chance you're gonna lose money there. Most people do. The best way to avoid losing money is to avoid getting involved. Having said that, I'm still continuing my weekly asset purchases, but I only stick to a very few companies which I strongly believe in, like Google, Microsoft, Procter & Gamble, along with gold and broad index funds. In fact, I am actually very bullish on gold right now. I think we may be entering a perfect storm for it, and you can see why in the video that I have linked in the comments below. So, why is it that I keep putting money in the markets, you may ask? Simple. Everything I just said up until now could turn out to be completely wrong, or it can turn out that I am reading the situation completely wrong. The Federal Reserve may come up with some new, ingenious way of saving and propping up the markets. Nobody can really tell the future, and that's why you have to hedge. When it comes to situations like these, you really need to realize that things can go in a few different ways, and you need to be prepared for both. I am putting aside more cash than normal to prepare for more potential problems in the financial system and the markets. But I also realize that may be averted somehow, so I am continuing with my weekly purchases which I mentioned before. If you have some great companies that you strongly believe in and you are certain that they are in a good place, trading for a good price and will continue to do well in the next 12 to 24 months, then by all means go for them. Indexes are a great way to go too. Obviously, be smart and don't overextend your positions. It can be tempting to put in a lot of money when you see a good opportunity, but like I said, you never know how it is going to turn out, so make sure you have spare cash. You don't want to be buying stocks with the rent money or the money you need for food and bills, especially when we have a looming recession on the horizon. This is obviously not financial advice, but I personally think it is just common sense. It can pay off being greedy in situations like these, but in my experience you get burnt more often than you get lucky, so be careful. Missing out on a deal is better than losing your hard-earned money on an impulsive bet driven by FOMO. On that note, that's all from me for today. Be smart, stay safe, leave a like and a comment, and I will talk to you again soon.